Something super weird is going on in the American housing market right now. If you've been tracking the space, you already know builders are having a really tough time. Mortgage rates are stuck up there, affordability is just maxed out, and buyers, they're sitting on their hands. Builders are basically having to throw massive incentives at people just to move inventory. So welcome to this explainer. We're going to dive right into one of the biggest financial mysteries baffling the market today. Technically, the smart money should be running for the hills right now. But as we're about to see, one of the greatest investment firms on the planet is doing the exact opposite. To really grasp the level of panic out there, you just have to look at this number, 41%. Lennar, which is one of America's absolute biggest home builders, has been trading roughly 41% below its 52-week high. I mean, for a massive company of this scale, a drop like that is a huge flashing red light. It signals a totally stretched, exhausted housing cycle. When a giant like Lennar takes a hit like this with buyers acting this cautious, the textbook reaction is to just stay away entirely.
And that perfectly sets up the contradiction we're digging into today. On one side, you've got this bleak reality, a struggling market crushed by high rates and affordability issues. But on the flip side, you have Berkshire Hathaway, steered by CEO Abel, going on an absolute buying spree. They didn't just hold on to what they had, they bumped up their Lennar position by about 30%, making it worth around $1.16 billion as of June 30th. They even started a new, smaller position in Horton. But the real kicker, the thing that made everyone do a double take, they just spent about $6.8 billion to buy the homebuilder Taylor Morrison completely outright.
So you gotta ask yourself, why is Abel increasing Berkshire's exposure to the exact industry everyone else is sprinting away from? Are they just scooping up cheap cyclical stocks, crossing their fingers that mortgage rates drop? Or is Berkshire seeing something way bigger? Because once you understand the actual machinery of what they're building here, I promise you, it's going to completely change how you look at home builder stocks.
Section 1. Assembling the ecosystem.
Let's follow the money here and look closely at the clues in these recent acquisitions, because this is definitely not just about picking up some random stocks on sale. What's super interesting is how this capital is deployed. You've got that $1.16 billion stake in Lennar and this tiny, almost exploratory $580,000 position in Horton. But the absolute behemoth on the board is that $6.8 billion outright purchase of Taylor Morrison. This tells us Berkshire isn't just dabbling in a housing investment. They're actually assembling a massive housing ecosystem. They already own Clayton, which gives them a huge footprint in manufactured housing, building materials, financing, and even paint. And now, they're anchoring all of that with a major national home builder. When you take Taylor Morrison and plug it into Berkshire's existing Clayton operations, the combined numbers are pretty staggering. Together, they delivered nearly 23,000 site-built homes in 2025. We're talking operations spread across 21 states, 52 housing markets, and over 700 communities. Honestly, without making any real fuss about it, Berkshire has quietly built the fourth largest U.S. site-built home building operation. They aren't just participating in the market anymore, they're swallowing a massive chunk of it whole.
Which brings us to the core thesis. The big realization is that Berkshire is not just closing their eyes and praying for house prices to go up. That's just not how they operate. This is a structural play. Berkshire believes the highly fragmented U.S. home building industry can be consolidated into a much more efficient platform. By bringing procurement, land development, construction, and financing all under one roof, they're placing a massive bet on long-term efficiency, completely regardless of what mortgage rates decide to do next Tuesday.
Section 2, the margin recovery bet. To figure out the mechanical lever driving this investment, we need to look at Lennar's financials. Their Q2 investor scorecard paints a picture of a company fighting incredibly hard just to tread water. They pulled in $7.9 billion in revenue, but home sale revenue actually dropped 2%. Orders were down 4% year over year. And that average price? It fell 5% down to $371,000. So Lennar isn't just sitting around waiting for buyers to show up. They're out there actively cutting prices and handing out roughly 12.9% in incentives just to keep their delivery volume up. And even with all that, they only managed a meager 2% increase in deliveries. It is brutal out there. But of all those numbers, here is the absolute most critical clue in this entire explainer. 15.6%. That was Lennar's gross margin on home sales for the quarter. Just 1 year earlier, that exact same number was 17.8%. Now, a drop of a little over 2 percentage points might not sound like a huge deal at first, but when you're moving billions of dollars in homes, we are talking about hundreds of millions of dollars in lost earnings. This margin compression right here, this is exactly why the stock got hammered. But here is the hidden lever the smart money is zeroing in on. Lennar's management expects Q3 margins to actually stabilize at approximately 16%. And this is exactly why Berkshire is making its move now. Their investment thesis doesn't need home prices to suddenly skyrocket. They don't need mortgage rates to crash overnight. Berkshire just needs volumes to stabilize, incentives to moderate a bit, and for those margins to start a slow, steady recovery. Because a stabilized margin on a massive volume of homes, that is a highly, highly profitable machine.
Section 3. The unfair advantage.
So why is Berkshire uniquely positioned to make this bet when other investors really can't? Well, first, let's look at the survival armor of Lennar. This company is literally built to survive this kind of cycle. They're sitting on $1.8 billion in homebuilding cash and a $3.1 billion untouched credit facility. Their debt to capital is sitting at a ridiculously low 15.8%, and maybe even more impressively, they own less than 5% of their land on their balance sheet while operating at a record construction cycle time of just 121 days. This is a business deliberately engineered to protect its volume, its capital, and its flexibility.
And this brings us to Berkshire's ultimate unfair advantage: time. A normal home builder, or even a regular investor, basically has to try and survive a turbulent housing cycle entirely on their own. They're completely at the mercy of market timing. But Berkshire Hathaway? They can just wait the cycle out. While they're sitting around waiting for housing to recover, they are constantly being fed by massive cash flows from their insurance, energy, and railroad businesses. They don't have to predict the exact month the housing market turns around. They can just position themselves early, scoop up depressed valuations, and patiently wait.
Section 4. The final verdict.
Okay, let's stress test this thesis and pull out some actionable takeaways based strictly on the evidence we've covered. If we're being objective, let's look at 3 scenarios. In a bear case, rates stay high, margins stay pressured. There's definitely more downside for Lennar, but again, Berkshire just waits it out. Now, the base case, demand stabilizes and those super expensive builder incentives finally drop off. Suddenly, today's depressed valuations start looking very, very interesting. And in a bull case where rates actually do fall and margins expand, we'd see a massive re-rating of public home builders. The main thing to remember here is that a successful investment in this space doesn't need a housing bubble. It literally just requires a return to normal conditions.
So, based on our source material, here is the investor action plan. For Berkshire Hathaway itself, it's a buy or hold. This housing expansion is just adding another fantastic, long-duration operating engine to their fortress. For Lennar, it's a watch and accumulate, but mostly for those with a pretty high risk tolerance. You never want to just blindly chase the smart money. You want to wait for actual confirmation that orders and margins are stabilizing. And as for D.R. Horton, just watch. That position is way too small right now to build a big thesis around, so we're just going to keep an eye on future 13F filings to see if Berkshire decides to size up. Now, if you're tracking the broader housing cycle yourself, here is the hidden timeline you absolutely need to memorize. The recovery is not going to be announced with a megaphone. The very first sign will be falling builder incentives. Step 2 will be rising orders. And step 3 will be improving margins. I can guarantee you, by the time rising earnings estimates actually make it into mainstream financial headlines, the market will have already priced it in, and the biggest window of opportunity will have already closed. Which leaves us with one final, pretty provocative thought. Don't just try to copy Berkshire, try to actually understand them. They are deliberately increasing their exposure to housing while the mainstream headlines still look absolutely terrible. It really begs the question, what if the rest of the market is completely fixated on today's housing weakness, while Berkshire is quietly buying tomorrow's housing market today? Keep a close eye on those margins, and thanks so much for joining me on this explainer.